Hey, if you're a private equity entrepreneur and you're sick of dealing with investor objections, in this short video, I'm going to break down the top 7 objections people get when they're raising capital and exactly how you should respond. Question number 1.
Why should I invest passively as to just buy these assets myself?
All right, now this is something I get all the time. And so when people ask me about this, I usually break down the typical economic split that we're talking about. In private equity, usually the owner-operator, the person that's doing all the dirty work so that the passive investors don't have to lift a finger, usually is getting part of the deal. That split is usually split somewhere like 80-20 or 70-30, with 80% going to the passive investors. So the reality is, all I have to do as an owner-operator is be 20% better than a passive investor to make up for my economic interest in the deal. All right, now this is a total no-brainer for most passive investors because the reality is most of them are doctors, lawyers, dentists. They're spending their time on their W-2. If they own their own business, that's what they're focused on. Now, meanwhile, you, the owner-operator, is all in on whatever your strategy is. So all you got to do is make the case that you're going to be way more than 20 or 30% better than they would, and that way you can justify your economic interest in the deal. Plus, you give them access to diversification in terms of whatever your niche is. Something else that I really like to talk about is that there's a really important distinction between LP investors and general partners. LP investors do not take on the same level of risk that general partners do. LP investors, that term is short for limited partnership. It also implies that there's limited liability. The liability that they have as a passive investor is limited to their investment amount. If something goes wrong at the property, let's say there's someone that passes away or someone has an injury or something like that, that liability may go on to you, the general partner, but will not be passed along to the passive investors, meaning that someone is not going to sue your passive investors. And guess what? The same is true of credit, meaning that you, the general partner, go on the loan. You're signing on the loan. The limited partner investors, the passive investors, are relying on your access to credit, your credit worthiness, and the fact that you're going on the loan, and are getting the benefit of the fact that you're going on the loan, but they're not incurring the risk of that debt. It's an incredible benefit for passive investors. I don't think it gets talked about enough. Number 2, I'm seeing a bunch of negative headlines about the economy. Why in the world would anyone invest right now? All right, now everybody knows about the quote from Warren Buffett, where you should be greedy when others are fearful. This is exactly how to respond to this question. The reality is you should be buying when blood is in the streets. And guess what? Distress, particularly distress in real estate, is incredibly rare. When you see 20 to 30% discounts in multifamily in particular, that is historically significant. Plus, it's a very unique opportunity because all of this distress that's taking place is just financial distress. It's not fundamental distress, meaning economies are booming. Unemployment is at historically significant lows. Fortune 500 companies are moving to some of these major markets, and there's incredible supply and demand imbalance for affordable housing, which investors can benefit from greatly. All of that's going on, and yet there are distressed sellers willing to sell their assets at 20 to 30% discounts from values that were happening just a couple of years ago. And why is that? Because most of those sellers took on floating rate debt, and interest rates rose faster than they've risen in 40 years, and it created all of this distress. But the reality is that distress is just financial distress. It's almost exclusively about interest rates and has very little to do with things like occupancy levels, let alone job growth, which is a more sound fundamental metric that doesn't go up and down and all around. Something else to consider is that because interest rates rose really, really quickly, development of a lot of these assets has fallen off a cliff. It usually takes around 2 years to develop commercial real estate properties. And so because of this, this demand is constantly growing, especially for affordable housing. So by the time we get to 2025 and 2026, the current existing assets are going to be highly occupied. There's going to be a huge demand for affordable housing. And I anticipate that values are going to dramatically increase when this happens because there's no new supply coming online, or at least the supply is incredibly limited. The combination of all these factors means that it's a very unique buying opportunity for people that are investing in quality markets. Something else to consider, though, is that when you buy when there's true distress in the market, all the metrics that you would use to determine how risky the investment is are cranked all the way down, especially compared to where they were just a couple years ago. So think about things like loan to value, debt service requirements, whether you have to take floating rate debt to make the deals pencil, or can you use fixed rate debt? Every single one of those metrics is cranked all the way down, meaning the risk of the investment should be perceived as far lower. Now, of course, it's more difficult to raise capital when people are fearful, but that's when you'll buy the best deals by far. Number 3, I've heard that there's been a ton of capital calls. Is that going to happen during this deal? Okay, it is true that for about 15 years, there was never any stories about capital calls in private equity investments, or they were very, very rare. And then all of a sudden, there's been a lot of capital calls in recent years. But why is that? Well, prices were bid up so high that a lot of the buyers were forced to take floating rate debt, which adjusts as interest rates rise or fall in order to make the deals pencil. And so what happened is interest rates rose faster than they've risen in 40 years. And when this happened, a lot of these owners saw their interest rates or their properties rise. Some of them even doubled or more. And this created a massive need for money. So a lot of these owner-operators were forced to do capital calls, whether for reserve requirements or for rate cap extensions and things like that. But all of this has to do with the fact that almost all of these deals that have had capital calls have used floating rate debt. And now, because prices have come down dramatically, because the lending market has changed significantly, you can buy assets with fixed rate debt. And when you do that, it completely changes the likelihood of a capital call happening. Now, in the world of private equity investments, it's always a risk, but there is a material change of that likelihood if you're using fixed rate debt, which you can do now because, like I said, every risk metric is cranked the other way. Plus, let's say you are using floating rate debt. The Fed has already raised interest rates dramatically. The federal funds rate went from like 1% to 5% in a very short period of time. So what's the likelihood that it's going to do that again, go from 5% to 10% or 11%? I don't think that's very likely looking at the economic data that I'm looking at. So if you're using floating rate debt, that is exactly what I would say. But if you're using fixed rate debt, obviously, I think it just totally changes the risk profile and dramatically reduces the likelihood of a capital call, because the person you're talking to, if they experienced a capital call, it's probably for a deal that had floating rate debt and dealt with exactly what I just outlined. Number 4, I'm scared of what I don't know. What are the biggest risks of this opportunity and how have you mitigated them? Now, when someone asks me this question, usually what I do is I start out by explaining that there's a couple of risks in the world of investing that we simply try to avoid at all costs and are really unique to our particular strategy. And I suggest you do the same. So I'll use my business as an example. We exclusively invest in Phoenix multifamily, and there's a lot of reasons for that. But one I talk to about investors a lot is the fact that there's no hurricanes in Phoenix. This is compared to other markets like Texas and Florida that a lot of our investors are usually contemplating investing in. So because there are no hurricanes, the insurance costs in Phoenix are far more predictable than they are in Texas or Florida. This is a massive double header, right? You don't have the hurricane risk and you don't have the insurance cost rising risk that a lot of these other investors are dealing with. And that doesn't mean there's no risk in the deal. It just means that there's a massive risk that a lot of investors are dealing with and exposing themselves to, and we're just not going to be taking on that risk in our particular strategy. So think about whatever risks are out there in the world of investing that your strategy totally avoids. And I would start with leading with a couple of those that make it clear that you've thought this through in a high level of detail and you're just taking those off the table. Then once I've gone through a couple of those risks, I then talk about specific risks of the investment opportunity. And I talk about what we've done to mitigate them. So you know more about your business than I do, but be open with them. Just be honest. Like, say, hey, here's the risk that we identified. Here's the steps we've taken to mitigate it. And I'll give you another example. Like I said, we invest in Phoenix multifamily. And so one risk people talk about all the time is the fact that there was a couple of articles that talked about how Phoenix is running out of water. So I lead with that. I talk about the fact that we know those articles exist. We talk about the due diligence we've done on the matter. We also talk about the fact that there's multiple Fortune 500 companies making billion-dollar investments in Phoenix and its surrounding markets, and thousands of employees are moving there because of this. This just shows that, look, yes, we can do our own due diligence, but the likelihood that these Fortune 500 companies and these international companies are making billion-dollar investments into Phoenix, they've done research that we don't have access to. To some degree, we can rely on their research. And lastly, I usually have a couple of resources prepared on that particular topic that I can send them after the call or after the investor presentation. So, like I said, you know more about your business than I do, but I'd be very well prepared. If you start to hear that your investors can't invest because of a certain risk, rather than hide from it, lean into it. Do a bunch of research on the topic, get some articles, get some podcasts, and next time an investor brings it up, you'll be well prepared and can send them those articles after the call or after the presentation. Number 5.
How are your incentives actually aligned with me, the passive investor?
Now, when I get this question, it's actually really good news because in the world of private equity, there is a lot of incentive alignment in these types of deals. The first thing I typically talk about is the fact that my friends and family invest in my deals. Yes, sure, I invest, but it's part of my business. I'm talking about my closest friends and family members. My mom is one of our largest investors. And additionally, our CPA, the person that sees every single transaction go in and out of our bank account, he is also an investor in many of our deals as well. This is huge to just show, hey, listen, I am all in on this strategy. I put my relationships on the line. My CPA, who can see every single transaction, is invested. I am totally committed to making sure these deals work. All right, now on the other side of the conversation, I talk about the massive incentive alignment that's there when it comes to the compensation structure. And again, you know more about your business than I do, but in my business, we only make around 20% of our money on the deal up front, and the other 80% only comes if they get a healthy return on their investment. It's subject to a preferred return, which is common in the world of private equity. So again, 20% of our compensation is not a lot. That's basically enough to keep the lights on in our business. We only really make serious money if investors not only get a return of capital, but additional returns above that, usually around 8% annualized, meaning that I only want to do deals that I think will perform, meaning return their investment and also give them a healthy return. That's where 80% of my compensation comes from. Here's what I usually like to do in this situation as well. I like to turn it back around on them and ask them, hey, listen, what is the incentive alignment with your financial advisor? Because the truth of the matter is most of them have a lot of their portfolio, a huge part of their net worth in an investment opportunity with a financial advisor where there is zero incentive alignment. Financial advisors get paid based on assets under management. They don't only get paid if they do well. In fact, they're only incentivized to try and go get more clients because it's really hard to pick stocks. So the reality is it's basically all a show. Now, of course, you don't want to be too confrontational with your investors, but the truth is, think about it. They're showing all the skepticism around incentive alignment, but I bet that most of their net worth is in an investment vehicle in which the person that's controlling it has zero incentive to actually do a good job. Number 6, the Fed has gone insane. They printed all this money. What if inflation comes back like it did in 2022? Okay, so I don't want to get too technical, but I've got to tell you, when people ask me about inflation, I usually break down my answer into 3 groups because there's 3 really important pieces of my perspective on this. The first, of course, is consumer price inflation, which is what most people think about when they talk about inflation. Okay, now in the world of private equity, you just gotta know that it's this unspoken reality that no one really wants to admit, but inflation is usually very, very good for investors. I'll give you an example. Let's say you're in the world of multifamily real estate, by the way. Let's say you have a property that has a gross income of $1 million a year and a net income of $500,000 a year, okay? So let's say that inflation is going out of control like it did in 2022. Let's just use an extreme example and say that inflation is at 10% per year and stays there. Okay, by the end of year 1, what's going to happen? That $1 million of gross income is going to go up by 10%. Now it's 1.1 million. Now what's going to happen to your expenses? They're also going to go up by 10%. So you've got $500,000 of expenses that by the end of year 1 are now $550,000. Okay. So what happened to your net income in that situation? It went from $500,000 to $550,000. So then what happens over a 5-year period? Well, that $1 million compounded at 10% per year over a 5-year period has gone from $1 million of gross revenue to $1.6 million of gross revenue. And what's happened on the expense side? Well, you've gone from $500,000 of expenses to around $800,000 of expenses. So then what has happened to your net operating income? It's gone from $500,000 a year to $800,000 a year. So your net operating income in this example went from $500,000 a year to $800,000 a year. And that doesn't even assume you actually know what you're doing. Like that doesn't mean you know how to manage the property right or that you bought a really good property. It's just the mathematical reality that your gross income number is bigger than your expense number. And when you compound a big number versus a small number, the net is going to increase. The net is going to increase. So that's really, really powerful from my perspective. And like I said, that's just one of three pieces of this answer. The second piece of it is asset price inflation. Okay. So when there is inflation, yes, consumer prices increase, and that's what most people think about, but also assets increase in value, meaning that the multiple on which they are traded increases. And I'll say that another way. If you're in real estate, this means that when there is inflation, cap rates typically go down. There's cap rate compression. So think about this. In this situation, you've got NOI increasing, and then the multiple on which that NOI is traded is also increasing due to asset price inflation. Now, this doesn't happen 100% of the time, but there's a pretty good correlation between as money is printed, asset values tend to rise for a lot of reasons. And there's a third piece of this, which I don't hear enough people talk about, especially when they're talking to passive investors, but it is huge, which is inflation-induced debt destruction. You know how if you have money sitting in a bank, you're always thinking, oh my gosh, it's getting eaten away by inflation? Well, the same is true of the dollars you owe the bank when you borrow money. So think about it like this. Let's say you buy a property or an existing business for $10 million, and you do this by putting $3 million down and taking a loan for $7 million. And when you do this, you basically create an IOU with the bank. You say, I owe you $7 million and I'll pay you later down the road. But that $7 million is in today's terms. But what happens if inflation happens at 10% per year during the 5-year period? Well, that's $7 million, and the purchasing power of that $7 million is eroded significantly. In fact, if it's 10% per year for 5 years, the purchasing power of that $7 million turns into $4 million in today's terms, meaning that the value of the money you have to pay back decreases by 60%. So think about this all together, right? You've got consumer price inflation, which is increasing rents and increasing your gross income and taking your net operating income from $500,000 a year to $800,000 a year. Then you have this concept of asset price inflation, so that NOI is traded at a higher multiple as inflation takes place and asset values rise. And then the trifecta, inflation-induced debt destruction, eroding the value of the dollars you have to pay back to the bank later down the road. This is why it is good when there is inflation to borrow money and buy quality assets. Now, we don't like to talk about it because inflation is not good for the consumer, and inflation is not good for people that are on fixed income and have low incomes. But guess what? Let's be honest. This whole conversation around the rich get richer and the poor get poorer, it's about inflation. The only question is, which side of that equation do you want to be on? So when you hear this conversation around the rich get richer and the poor get poorer, this is what they're talking about. Inflation creates this. It's only a matter of which side of the equation you and your investors are going to be on. So I always make that clear to investors. Inflation is actually generally very good for private equity investments. Number 7, what if there's a black swan event? What if there's a war? What if the dollar loses its status as the global reserve currency or anything like that? All right, now look, black swan events are real. Okay, unpredictable things happen all the time. But here's the question you want to ask your passive investors. If something like that happens, where do you want your money? Because where they should want their money is in quality assets, in quality markets that are managed by quality operators that have incredible incentive alignment to deliver on their promises to them, the passive investors. So think about it. If you're buying quality assets in quality markets and you're a quality operator that knows how to add value to these properties, it's not going to matter what happens in the news or who wins the election or whether or not there's a recession. These quality assets will remain quality assets, and hopefully you can do your job and increase the value of these properties. And you have to make the case to the passive investors that that's exactly what you are. Now, of course, when it comes to these unique things about like the dollar losing its status as the reserve currency, if you go to sell your asset and it's a quality asset in a quality market, it doesn't matter if the buyer wants to pay you in Bitcoin or yuan or US dollars. It doesn't matter on which currency the asset is traded. What matters is that the asset is quality. So keep that in mind, and I really hope that helps. All right, now if you got a lot out of this video, hopefully you did, and hopefully you want to see more, all you got to do is like this video. If you can, comment below depending on what platform you're watching, and give me a follow, give me a subscribe. I want to know if you're getting a lot out of this, and hopefully you are, so I'll make more videos like this. Plus, if you're interested in learning more about how you can raise capital, comment the word capital below, and me or someone on my team will reach out to you, and we'll see if we're a good fit. I've helped hundreds of capital raisers and real estate entrepreneurs, private equity people, people that want to buy existing businesses, people that want to own and manage funds. I've helped hundreds of people raise quite a bit of money implementing systems and strategies into their business so that they can attract investors. So like I said, if you got a lot out of this, comment the word capital below. I'll reach out. Hope to talk to you soon.